want an exposure to a market or an
Everything they need in one place.
Being the world's foremost authority on individuals, advisors and institutions.
Hello and welcome to Morningstar. I'm Emma Wall, and here with me today to give his 3 stock picks is Jamie Hooper, manager of the AXA Framlington UK Growth Fund. Hello, Jamie.
Hi.
So what's your first UK stock?
First stock I'd like to talk about is a UK company, but very much a play on global economic growth. It's one of my core compounders, if you like, my long-term winners, these companies that can do it year in and year out. The company's name is Compass. It's the world leader in contract catering, which is a £200 billion per annum market. They dominate, but they only have a 10% market share, so it's incredibly fragmented. There are wonderful opportunities for synergies, economies of scale, etc. Half of the business is coming from North America, which we know has an economic upturn. 30% is from Europe and UK. UK is recovering strongly. They've taken strong restructuring efforts in Europe. And then finally, 20% is from emerging markets. So this is the kind of company that I love. I mean, this is 4 to 5% organic earnings growth, 8 to 9, 10% earnings growth, and then you add to that a nice dividend yield and nice share buyback. So a great company as a long-term core holding.
Somebody who doesn't know the company, hearing catering and hearing emerging markets, is there not a risk that they'll just be undercut by domestic companies in that region because they won't be cheap enough?
There is a case for that. They actually would argue that's the very opportunity. You have lots of individual, very small independents who cannot procure, obtain, fulfil contracts on the same economies of scale that Compass. So Compass is buying across the world, is a preferred supplier, and they can offer preferential terms to either businesses or local government authorities in those geographies.
And what's your second stock then?
The second stock is quite different. It's a play on domestic cyclical recovery. It's Hayes, the specialist recruitment company. About a third of its business is exposed to the UK, which we now know is showing incredibly strong recovery. 20% is exposed to Germany, which has a strong structural growth. The balance are other economies, but predominantly Australia, which has been woeful. It's had a 70% decline, predominantly due to the mining industry. But we now see signs of stabilisation. The company next update in April, and we expect that to exceed expectations. And finally, over the next 12 to 18 months, I suspect greater capital returns, either through dividends, share buybacks and special dividends.
I mean, that company strikes me as one that's very sensitive to what's going on in the macro, what's going on in the economy. Does that worry you, or is that part of the play?
Yeah, it's very operationally geared, as you say, to the recovery in developed markets. Developed markets have had 5 years of turmoil. It's only really now we're in the nascent signs of recovery. Let me put it to you clearly. Consensus profit expectations for the UK in a couple of years' time is £40 million. This company earned £140 million at its peak. I think the balance of risk to market expectations are clearly on the upside.
And what about the third stock then?
Again, a different kind of stock. This would be a mega cap. Mega caps generally we call them mega traps. You wish to avoid them. The UK, almost 50% of our market, is very concentrated in 20 companies, and I generally try and avoid those. But on occasion, where they're both cheap and changing, selectively I'll look to acquire. Now, AstraZeneca is a company that I've been buying over the last 3 to 6 months. What's its story? Well, it's been subject to numerous generic challenges and patent expiries. Profits have been in decline for a number of years. But what's changing? Firstly, they've got a very strong balance sheet, and they're going to employ that to make bolt-on acquisitions, which will start to boost profits. But secondly, and more importantly, they have a wonderful pipeline of drugs, particularly in the immunotherapy cancer treatment area. And therefore, I think that they will again exceed expectations. And then perhaps finally, just simply from a portfolio construction perspective, markets have run hard and they've run well for a long time now. If one is concerned that a correction is due, this has a low beta, so it's very cautious and defensive, which is all part of creating a balanced core portfolio.
I think people hear of pharmaceutical and they do think patent cliff.
Yeah.
You're saying there that these drugs are coming through the pipeline. Is that a guaranteed source of revenue?
So they've had 35% declines. Again, we're very interested in consensus expectations, and people have been downgrading for 5 years, and it's interesting that people are coming to the end of the downgrades. There's also new management at the company who acknowledge that, but now advocate that profits in 2017 will be the same as they were in 2012. That's very aggressive, but it's very positive relative to quite a bearish consensus opinion on this company.
Jamie, thank you very much.
Thank you.
This is Emma Wall from Morningstar. Thank you for watching.